Visualize a scenario that is all too familiar on your trading screen. The price is moving exactly as you analyzed. Green candles are stacking up. Your account balance is ticking higher. You feel confident because you placed a safe stop loss right below a very clear support zone. But then, in just 1 or 2 candles, the market does a complete 180. A long wick pierces straight through your stop loss, wiping out your order. And immediately after that, the price reverses and shoots straight up in the exact direction you predicted. How many times have you seen this? Your stop loss gets sniped by the market to the exact pip before the price finally decides to move correctly. It's a mix of rage, helplessness, and confusion. Inside your head, there is only one question. Why is my stop loss always hunted first, before the real move happens? Almost every trader has their own version of this story. Let's call this character Nam. Nam has studied candlestick patterns, support and resistance, and trend lines. One night, Nam sees a textbook setup. An uptrend, a retest of the support zone, and a rejection candle appears. Nam buys, placing his stop loss right below the wick. A few candles later, the market plunges right into Nam's stop zone, cuts the trade, and then rockets back up. Correct analysis, but wrong location. If he was still in the trade, he would be in profit. But in reality, his account just got a little smaller. What is Nam thinking right now? The broker is rigging it. The market is dirty today. They must have seen my stop loss to hunt it that precisely. That frustration easily leads to a familiar decision, entering a new trade immediately to get even. This time ignoring the stop loss or doubling the volume. And from that moment, Nam is no longer trading based on a plan. He is trading based on a wounded ego. If you see yourself in Nam's story, you are not alone. Millions of retail traders, from Vietnam to every corner of the globe, are stuck in this exact loop. Analyze correctly, enter at the wrong spot, get stopped out, get angry, and watch their accounts bleed. But if we stop at just blaming the broker or the market, tomorrow, history will repeat itself. Before we go deeper, let me introduce myself briefly. This is Sweep Trading, where I share how to trade based on market structure, not emotion, no get-rich-quick dreams, no promises of a 99% win rate strategy. If you want to understand the market from the perspective of big money, of smart money, instead of just sitting there blaming the exchange, hit that subscribe button and turn on the notification bell. We are going to walk a long path together. We are not here to survive on luck. Now, back to the question. Is there really someone sitting behind a screen, watching your 0.01 lot trade, waiting to push a button to hunt your stop loss? If you were a bank or a massive hedge fund, would you have the time to stalk individual accounts worth a few $100s? The answer is usually no. But that doesn't mean the feeling of being hunted is imaginary. In this market, yes, there are some shady brokers and price manipulation tricks, but behind that feeling of a stop hunt lies a much bigger story. The story of liquidity and of those who are forced to trade with massive volume. They cannot enter trades randomly like a retail trader. They need price zones with enough opposing orders, enough people willing to buy or sell against them. Those zones are what we call liquidity pools. Every time you and thousands of other traders see the same support zone, place your stop loss right below it. You are unknowingly contributing your order to a shared pool of liquidity. When that pool is full, a shark swims in, swallows it whole with a liquidity grab candle, breaking the low and then reversing. Those candles you call stop hunts are often the exact moment someone is using the crowd's liquidity to build their massive position. In this video, we will answer 3 questions. First, who is smart money really? And why do we say sharks never sleep? Second, what exactly is liquidity? And how does it relate to your stop loss being swept? And third, how do you go from being bait for the sharks to learning how to view the market through the eyes of smart money? To answer these, we must temporarily set aside those fancy-colored indicators and learn to see the market in the true language of the money movers, the language of structure and liquidity. Now, to remove the fog of mystery surrounding the sharks, we need to agree on a very important concept. Who exactly is smart money? When you hear the phrase smart money, many people immediately think of a mysterious group of elites who can control the market, see every single trade, and always win. Actually, the truth is much simpler than that, but it is also much colder. Smart money, to put it simply, refers to major capital flows that are forced to trade with massive volume. We are talking about banks, hedge funds, financial institutions, market makers, and liquidity providers. They are not retail traders sitting there clicking 0.01 or 0.1 lots. They are processing numbers in the millions, tens of millions, or even billions of dollars. So, what is the common trait among all these big players? They cannot just enter a trade whenever they feel like it, or click buy and sell in the middle of a chart for fun. Every time they place an order, the volume is so massive that the market would easily suffer from slippage if there isn't enough liquidity. So, what they care about is not a beautiful candlestick pattern, nor is it whether an indicator is flashing green or red. The only thing they care about is, where is there enough opposing volume for me to fill my position at the best possible price? You can visualize it like this. If you want to buy 1 kilogram of gold, you can walk into any jewelry store. But if you want to buy 10 tons of gold, you can no longer buy it in small retail amounts. You must organize the transaction in places where there are people willing to sell you that exact quantity at the price you accept. The financial market works the same way. Smart money isn't a fortune teller predicting the future.
Liquidity.
They simply understand how the market revolves around liquidity, and they exploit that better than anyone else. So, what is liquidity through the eyes of smart money? Many people hear the word liquidity and immediately think of trading volume or how active the market is. That is not wrong, but for smart money, liquidity is more specific than that. It is the specific price areas where a large cluster of pending orders from the crowd is gathered. This includes stop losses, stop orders, and pending orders. The places where the whole village places their stop loss create delicious pools of liquidity for the sharks. What are typical liquidity pools? First, we have equal highs and equal lows, those peaks and troughs that look very clean on the chart. Many retail traders consider these to be strong support or resistance, so they place orders right next to them with a stop loss just on the other side. Next are the very obvious highs and lows on the H1 or H4 timeframes, places that anyone opening a chart can see and draw a horizontal line across. Then there are the highs and lows of the Asian, European, and US sessions. Many intraday systems use these as entry triggers. And don't forget the classic patterns: double top, double bottom, head and shoulders. Places that textbooks, courses, and YouTube teach everyone to look at. This causes thousands of traders to look at the same spot, enter at the same spot, and place their stops in the same area. When you zoom out and see a zone that everyone is watching, it is almost certain that underneath that zone lies a massive pool of liquidity. For smart money, the most important question when looking at a chart is not, what is the RSI level? Is the MACD crossing up? Are the Bollinger Bands squeezing? Instead, the question is, where is the crowd placing their stop loss? When you start asking yourself that question every time you open a chart, you are getting closer to the perspective of smart money. But why does smart money have to hunt these liquidity pools? Let's go back to the problem of massive volume. When you enter a 0.1 or 1 lot trade, the market barely feels you. But if you want to push in 500 lots, 1,000 lots, or more, you need a place where many people are willing to take the opposite side of your trade, so your order gets filled smoothly. If there aren't enough opposing orders, the price will slip, and you will enter at a much worse price than you intended. Therefore, smart money must find a way to accumulate or distribute their positions in areas with dense liquidity. When they want to buy big, they need a lot of sellers, meaning they need a price zone where the crowd is panic selling, getting stopped out of buy positions, or selling a breakout. When they want to sell big, they need a lot of buyers, meaning they prefer zones where the crowd is FOMO buying a breakout, believing the resistance is broken and the price will fly. That is why you often see a familiar script. Price pretends to break a clear high or low, sucks in the stop losses and breakout orders of retail traders, and then immediately reverses, leaving behind a long wick. For smart money, that is the moment they use the massive liquidity sitting in those stop losses to build their huge positions. For the retail trader, it is just another sigh. The broker is hunting my stop again. Here, we also need to clear up 3 very common misconceptions about smart money. Misconception. Number 1. Smart money is always right. Just trade against retail and you win. The truth is, smart money has losing trades too. Things don't always go their way. The real difference is in how they manage risk, and that they follow a system with a positive expectancy in the long run, rather than clinging to a single trade. Misconception number 2. You just need to learn a few SMC patterns to become smart money. Many people learn terms like boss, shotch, order block, FVG, and think they have mastered the shark's secret. But those patterns are just the language to describe price behavior around liquidity and structure. The core is still, do you truly understand how liquidity flows, and do you have a clear framework to read market structure? Misconception number 3. Smart money sees my specific individual trade. The feeling of being stopped out exactly at the wick makes you feel like someone is staring directly at your account. In reality, they don't need to, and they cannot care about every single small account. They look at clusters of orders, price zones where hundreds, thousands, or even tens of thousands of stop losses are sitting together. If you place your stop exactly where everyone else places it, you voluntarily turn yourself into part of the liquidity pool they want to consume. When you shift your perspective from "the market is playing me" to "where am I located in the market's liquidity picture," everything starts to change. To ensure these concepts aren't just empty theory, in the next section, we will look at 2 real-world chart examples together to see clearly how sharks use liquidity in those peak and valley sweeps that you encounter every day. Now, let's look straight at the chart so that everything we just discussed doesn't remain just abstract theory. Imagine on your screen right now is the EUR, USD or GBP, USD pair on the H1 timeframe. In the last few days, price has been moving up steadily, creating a very clean uptrend. Every time it retraces, there is another push higher. Then, at one point, the market starts to create a ceiling where price touches multiple times but fails to break through. Traders call this resistance a ceiling, a place where price keeps getting rejected. If you zoom in closely, you will see 2 or 3 peaks that are almost perfectly level, a very clear cluster of equal highs. For the majority of retail traders, this zone is the ideal place to place a sell order. It's strong resistance, just sell when it gets there. Those who sold already usually place their stop loss just a few pips above that cluster of highs. Those who haven't entered but love to trade breakouts will place buy stops above, expecting that if this high breaks, the market will fly to the moon. What is the result? Right above that cluster of equal highs, a massive pool of liquidity is formed. Stop losses from sellers and buy stops from breakout traders, all gathered into one price zone that smart money cares about deeply. Then a new trading session opens. The market starts inching towards that cluster of highs. Green candles stack up. The distance to resistance gets shorter and shorter. Sellers are anxious. Is it going to break? Breakout traders are excited. Just a little more to hit my buy stop. And then, a massive candle appears. It stabs straight up, piercing right through those equal highs, triggering all the buy stops and wiping out the stop losses of early sellers. On your screen, you see price breaking the high. But if you look closely at that candle, you will see one thing. It leaves behind a very long wick, and the body closes back below the resistance zone. In the next few candles, price does not fly, as the breakout traders hoped. Instead, it starts to turn around, inch by inch, and then plunges straight down. What just happened? In the moment that candle pierced the highs, smart money used that massive liquidity above to fill their huge sell orders at a premium price. They used retail buying power, the buy stops and panic closes, to sell into. Once they had enough liquidity, they had no reason to keep price up there. The market reverses, leaving behind retail accounts that just bought the top perfectly. If you bought the breakout right then, placing your stop below the old high, you are the liquidity. If you sold early, placing your stop right above the equal highs, you are also liquidity. Two sides fighting, thinking they are fighting the market, but actually providing opposing orders for the same group of people. The only difference is your position. Buying the breakout at the top usually makes you food. Waiting for the sweep, waiting for confirmation of reversal, and then finding an entry based on structure means you start walking in the same direction as smart money. That was a classic high sweep. Now, let's move to a scenario just as familiar. Sweeping the Asian low and reversing hard in the London session. Switch to another chart, say gold or GBP, USD on the M15 timeframe. Throughout the Asian session, the market didn't do much. Price was choppy, moving sideways in a clear range, with a bottom that was touched again and again. Many intraday systems treat the Asian low as temporary support. Buyers enter around that low, placing stop losses right underneath. Breakout sellers place sell stops below the range, hoping to catch a downtrend if London pushes hard. Once again, right below the Asian low, you have a very clear liquidity pool. stop losses from buyers, and sell stops from breakout traders. For smart money, that zone is the ideal place to find liquidity for a massive buy order if their bigger picture is to push price up that day. When London prepares to open, volume starts to increase. The M15 candles get longer, volatility spikes. Then you see a fast stab down. Price pierces straight through the range bottom, triggering all the stop losses and sell stops sitting below. Those who bought Asian session get kicked out. Those with sell stops get triggered, feeling like, I caught the downtrend. But if you watch that candle closely, or the next one or two, you see a familiar image, a long wick stabbing down, but the body closes back above the old low. From that moment on, instead of crashing, the market turns around. London pushes price up hard, blasting back through the Asian range, and continues to rally. Asian buyers were kicked out right before price went their way. Breakout sellers are trapped in a terrible position as price goes completely against them. The only ones smiling are those who quietly accumulated a large buy position right below the Asian low, using those exact stop losses and sell stops as fuel. This is an extremely common pattern in intraday trading. Range, sweep, reversal. Market goes sideways, accumulating orders. Then comes the sweep, grabbing liquidity on one or both sides. And finally, the reversal, moving in the opposite direction of the sweep, taking price to where big money actually wants to go. If you only look with retail eyes, you see failed support breaks, you see a dirty market. If you look with smart money eyes, you see, right there, they just grabbed liquidity to enter. Once you start recognizing these liquidity patterns, sweeping highs then dropping, sweeping Asian lows then rallying in London, you will feel less need to scream at the screen. Instead, you will ask yourself, in this scenario, where am I standing? Am I moving with the liquidity flow? Or am I becoming the liquidity? Those stop hunts you encounter are not personal. The market doesn't have time to hate your small individual account. It just does its job. Moving from one liquidity pool to another, finding enough opposing orders for the big players. The rest is your choice. Do you want to continue being the liquidity lying exactly where the sweep happens? Or do you want to learn to wait for others to be swept first before joining the big money move? We have reached the end. I don't want you to just nod your head, say, cool video, and then trade exactly the same way tomorrow. I want you to have a concrete framework to bring into every single trade. So, before you click buy or sell, pause for a few seconds and ask yourself these 5 questions. Question number 1. Am I placing my order AT a liquidity pool or after the liquidity has just been swept? Look closely. Are you buying exactly where everyone else is placing their stop loss? Or are you buying after the market has already swept those stops and started to reverse? The difference lies entirely in your timing. Question number 2. Is there a clean cluster of equal highs, equal lows, or an obvious Asian session high, low right above or below my order? If the answer is yes, chances are your stop loss is sitting at the same table as everyone else's. And as you know, where the crowd places their stops is an all-you-can-eat buffet for smart money. Question number 3. Is the breakout I see a real break or just a liquidity wick? Do not rush to trust price just because it pokes through a line. Look at how the candle closes. Look at the reaction after the break. If it is just a long wick and price reverses immediately, it is likely a liquidity grab, not a real breakout. Question number 4. If this trade hits stop loss, am I losing in the same spot as 90% of other traders? If the answer is yes, meaning your stop is in the most obvious spot, think again. Losing with the crowd means you are part of the liquidity pool, not the observer of it. And question number 5. Am I entering this trade based on my system, or because I just got stopped out and want revenge? If that voice inside your head says, I must win back what I just lost, the best move is to step away. Smart money never sleeps, but they are never in a rush. Only your dopamine is in a rush. To train your eyes to see liquidity, after this video, I want you to do a specific exercise. Open the chart of your favorite pair for the last 2 to 4 weeks. Scroll from left to right and mark these spots. Every time price broke a high or low with a long wick and reversed. Every time the Asian low was swept and London reversed. For each point, pause and ask, if I had today's smart money perspective back then, where would I be? How many times did I get swept in these exact spots? Just write down 3 to 5 scenarios where you definitely took the bait. This lesson will no longer be just theory from some YouTuber, but your own personal story. Finally, remember one thing. Smart money never sleeps. The market is always moving from one liquidity pool to another. If you trade on emotion, reacting instantly after every loss, you will always be liquidity for them. The goal of sweep trading is to help you trade based on structure, not emotion. If this video helped you, wake up, hit that subscribe button, and turn on the bell so you don't miss what's coming next. In the next video, we will dive deep into dopamine and why IT is the culprit behind blown accounts, not just the broker hunting stops. And if you have ever been stopped out right before price went your way, comment the words "woke up" below so you know you are not alone in this game.